Do you trade options and need help growing your account? Are you trying to generate consistent monthly income? If you said yes, then look no further. No matter your trading account size, OptionsTradingSignals.com will teach you how to find winning option plays, execute trades, and profit from the passage of time known as theta. Visit www.OptionsTradingSignals.com today. Welcome to the Technical Traders Podcast, the show that brings you technically proven strategies and trade ideas from experts around the world. We're going to help you make more money with less risk so you can take your trading to the next level. Now, here's your host, Jim Goddard.
My guest is Rob Isbitts. He's the co-founder and chief investment strategist for SunGardenInvestment.com. Whereabouts are you, Rob?
I am in South Florida, where I've lived for 25 years after being raised in northern New Jersey near New York City.
So you had decent pizza growing up.
We did. Pizza, bagels, Chinese food, and we replaced the pizza down here. The bagels, not so much, and the Chinese food. Let's talk about something else, Jim.
Rob, SunGardenInvestment.com. Can you just tell us a little bit about what is the company all about?
Sure. So I'm a former financial advisor, investment advisor, and we have pretty much boiled down. I sold my practice a couple of years ago, retained the investment management role, but these days there are four different things that we do. We speak with financial advisors and investors in kind of an open, casual format to try to help them based on my experience. We also do some hourly consulting because I have been around the block in the industry, and advisors tend to find that helpful. The third thing we do is that we manage model signals and distribute those through platforms. And the fourth thing that we do is something that we just put the finishing touches on after a couple of years. We affectionately call it not the robot, but the Robot, because it takes my 35 years of investment experience and pretty much turns it into a black box algorithm that enables advisors or investors to create their own portfolios. We just provide the infrastructure, the framework, and the mechanism.
How did you get started in trading or investing?
Well, my father taught me to chart stocks when I was 16 years old. So it was back in 1980. He never did it professionally. He certainly hoped I'd get into the business eventually, and I did. And he lived long enough for me to see that. He passed away about 9 years ago. And so I started with charting, made my way to Wall Street starting in 1986 in the World Trade Center in the back office for a Japanese bank, and kind of made my way through brokerage, through fiduciary investment advisory, and along the way developed my own approach to technical analysis, which, like I just mentioned, is now part of whatever we end up calling what is currently known as the Robot. I'm an avid chartist. I put it this way: my wife will occasionally catch me night charting because to me it's as relaxing as it is. It's as relaxing in off hours as it is exhilarating and motivational during the trading day.
Nothing worse than the wife catching you charting in the middle of the night.
That's right. Yep. Well, that's kind of a takeoff on the old Chevy Chase line from Caddyshack. Night putting. No, for me, it's night charting because I'm not a great golfer.
Is there anybody you really admire or influenced you to become involved in the financial markets?
Well, to some degree, I feel like I am fulfilling what my father was not able to do because he had a corporate career and he was raising us in Jersey, and he and my mom, but he did make his retirement, his modest retirement, last about 30 years. And so that was a big part of it. And I think today, in the way that you kind of go from generation to generation, I'm Jewish, and we have an expression, door to door, from generation to generation. And what I learned from my dad, I've now imparted on my son, who is a newbie in the wealth management business, and hopefully the work ethic that my two daughters, both living in the Boston area, will take. So I think it started with Dad. I've certainly had plenty of other influences along the way, but more in the collective than, let's say, a specific mentor. I will say this, though, as I've gotten to this point in my career, I'm in my second half of my 50s, and one of the things I enjoy more than anything else is mentoring other folks, whether they be professional or otherwise, to try to teach them what I've learned, and try to succeed, not just from my successes, but even more so from the many, many, many mistakes I've made along the way, whether it is in developing a technical analysis system or in any of the other ways that I've approached investment management and strategy.
What's your trading philosophy? What set of principles, beliefs, or experiences drive your decisions?
Like that question. And fortunately, I think I have a cogent answer. So it starts with what we at Sun Garden Investment Publishing call ABL, avoid big loss. And big is different for everybody. When I was an advisor and I was giving specific advice to clients, everybody had a different definition of the B for big. For some people, it was a few percent. For other people, it was many percent. And for some, it was in between. So it all starts with that. And then I think the sort of a corollary to that is, risk management is so important. I think a lot of people bandy around that term, but to me, it really means that you have 5 possible outcomes whenever you make an investment. You can make a lot, you can make a little, break even, you can lose a little, you can lose a lot. You need to take the lose a lot off the table. That is the biggest threat to your practice if you're an advisor, and to your lifestyle if you're an advisor or an individual investor.
What is your favorite type of analysis or indicator you help find to time your trades or your investments?
Well, I did create a lot of this stuff myself, and I saw my dad do it for so long, toiling away when I was a kid. Again, he never did it professionally, and so when I had the opportunity and I was able to do it full time, I've looked at it this way. My favorite oscillating indicator by far is the percentage price oscillator, the PPO. And, in the programming that we did over the last couple of years to create this kind of automated portfolio creation tool, we worked at that pretty hard because it is difficult, whether it's that or whether it's moving averages or trend lines, things like that. It is very difficult, I think, to translate what humans do into algorithms. You can do it, but I think it's fraught with potential error. And but I think we did a pretty nice job of humanizing, or I should say algoizing as much of the humans as we can. I think the other thing I would say, just in terms of sort of the pure technicals, I have found, this is more just from experience than anything else, you look at the direction of a 20-period moving average, and to me, that gives you a pretty good idea. In fact, we have something that we developed fairly recently. I've developed a lot of intellectual property around investing and around technical analysis. But the one that we've been talking about with folks recently, we call it the crash helmet indicator. It is any time that the 20-week moving average of the S&P 500 is where the price is 5% below that moving average or more. and it has kind of an uncanny record of forecasting future stock prices, let's say about 6 months out. And let's put it this way, that indicator fired recently, and so there are no absolutes in investing, and certainly not in technical analysis. Everything that I do as an investor is not about absolute. It's about evaluating risk versus the reward you're seeking. And but that indicator fired pretty recently, just in the last week or so. And so I would say that this is probably the most dangerous stock market that I have seen in my 35, 36-year career. That said, that also means there's the most opportunity, because there's a lot of folks who haven't seen this type of environment, and they're kind of newbies, and so they don't know what they don't know. And so here I am, kind of feeling like I'm a little bit in catbird seat, because I've been through 5 bear markets already, and this is one, it'll be 6.
Is there something you wish you would have known before you started trading and investing?
How much time do you have?
Lots.
Yeah, let's see. And it's funny, I mean, when you and I were chatting a little bit before this interview offline, that it's about trading and investing. Yeah, I mean, look, it'll make you humble really quickly. I think some of the biggest shortcomings in my track record, my audited track record, is that when you get these V bottoms, and who knows when we get the next one. I mean, as we're speaking today, there's a V bottom, but it's overnight, and it's on a very, very, very short-term period. If you can measure it in hours and half hours, and I'm not a trader as much as I am an investor who doesn't define time frames. But those V bottoms and determining how aggressive one should be. There's an old Wall Street expression, they don't ring the bell at the top or the bottom, but 2020 was a period in which they kind of did. And so being a conservative investor by nature, you're always kind of looking around to see if there's another shoe to drop. And so I think probably doing we're always trying to improve. And frankly, that's one reason we did the algorithmic version of Rob Isbitts, because the algo we found when we back tested it is that it does better in all periods other than the most chaotic ones, to the downside, because a human has to step in and take the algo. So I guess if there's anything I've learned, really, it's that it's good to have automated input, but at the end of the day, the human has to make the decision. And I think that people are better off that way, but algo assisted, in other words, the algo is the analyst, and a human is a portfolio manager. I think that's a great combination. I think the other thing that I wish I had known earlier is time frame analysis. I look at about a dozen different time frames, for everything from a minute all the way up to monthly prices in my charting. And I look at about 300 ETFs, which cover about 150 market segments. So you're always looking for something that gives you a fighting chance to make money without having a huge loss potential. And so I think that's that's really it. Being able to look at a wide span of things and look at them over multiple time periods. The period that we're in here, as we talk in March of 2022, the market has been just absolutely destroyed to start the year. I'm happy to say I'm one of the few people on the street that is actually making money this year. So far, so good. And I think what that comes down to is that one of the adjustments that I did not make when I was a young chartist, but I do make as a older chartist, is that it's I focus most of my time on daily, weekly charts, even the monthly. But when volatility kicks up and you have sort of external factors like we have going on with a horrific war, inflation, Fed, et cetera, everything speeds up, and you have to speed up your analysis too. So as we're sitting here, in March of 2022, I'm looking at 2-hour and 4-hour charts the way I normally look at daily and weekly charts, and making that conversion to correspond to the market that you're in. It's kind of like play the market that you're in, not the market that you wish you were in. And I think that's generally just part of being a good, flexible chartist and flexible investor.
You focus on ETFs only. Why is that?
Well, that was process of elimination. I was a stock investor for a long time. I do a lot of option work in my personal account. They're really difficult options. They're difficult to scale, and when you manage money in scale for a lot of different accounts, I'd love to find somebody that feels like they can do it. I've managed a mutual fund on 3 different occasions, and I use options in the mutual fund, and I happen to think they're an incredible tool, especially if you know how to use them. But it's difficult, let's say if you're, back in my financial advisor days, when you're trying to run it across a lot of accounts, get all the trades in. Systems aren't set up to handle that as smoothly as they are listed securities like stocks and ETFs. With stocks, it got to the point where, sort of like fool me once, shame on you, fool me a dozen times, shame on me. So many times where, you buy good companies, the charts are in sync, and then quarterly earnings comes out and they miss by a penny or whatever. Wall Street has this game that one of my peers in the business calls millennial soccer. Everybody gets a trophy. So you see the analyst estimates come down, 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 and then they beat by a penny, or they miss by a penny. Either way, when you see blue chip companies drop 10% before you can do a thing, I started to realize that if we're going to manage money for total return, avoid big loss, then make as much as you can, it's kind of the second rule, then individual stocks carry too much peripheral risk compared to ETFs. And frankly, in a lot of the ETF work that we do, I mentioned we follow about 300 of them, we look very closely at the underlying holding. And I am a big fan of concentrated ETFs. That's kind of how we bridge the gap. Like, to me, just speaking sort of generically, I would rather own an ETF that is based on the Dow than on, let's say, the S&P 500 or the NASDAQ or the Russell 2000, because at least I can chart 30 companies and I can get a pretty good idea. In fact, one of the things we do with Dow is we look at the Dow the way it's normally posted, but it's got this quirky weighting system where it's by price. But there are ETFs for equal weighted Dow. There are ETFs for dividend weighted Dow. And so, if you only have to analyze 30 stocks and they're all well-known blue chip companies, you can look inside and that gives you a better idea about how the full ETF is going to do. The one last thing I'd say about things I invest in and things I don't, probably my the biggest flag that I've been waving for the past decade is that bonds are, as an investment class, are not dying. They're past tense. They're gone. You can use them as trading tools through an ETF if you want to, and we do, long and short. But in terms of bonds as part of a 60-40 portfolio, dead. Bonds as a standalone asset class, dead. And my main strategy, the Sun Garden Core portfolio, which we've run for a long time, almost 20 years now, was created to specifically target and give investors something that they could substitute for their high-quality bonds and their corporate bonds, because those are areas that are treacherous for investors, but investors do not quite realize just how treacherous they are. I think they're starting to find out.
You're known for your bond replacement portfolio. What is it, and how does it work?
So what we do is we play offense and defense at the same time. That's really the key. It's not long short per se, because we use ETFs and we are buying or we are long ETFs on both sides. But offense and defense, think of it this way. In the same way, a football team in the U.S., an NFL team, the offense is on the field and the defense is on the field. Well, the offense does the scoring, right? Well, no, the defense can score too, but the defense's main job is to play defense. So I think a portfolio should always have an offense and a defense. And frankly, especially since I'm a big fan of our northern neighbors, Canada, and that's where you hail from. Then I think analogizing it to hockey is even better. Depending on the game situation in hockey, you are either going to be pressing, or you're going to be in a defensive shell, or you're going to be somewhere in between. I was a very, very, very amateur hockey player for about a decade of my life. Loved the sport. Still a big fan, as is my son. And when I watch a hockey game now, I think to myself, okay, if I see an offensive defenseman sort of pinching in and trying to get another goal on the board, versus that same defenseman really not pressing up too much, that is almost identical to the way I think of navigating markets in a portfolio. Sometimes you're pushing it a little bit more, sometimes a little less. And this is not a go to cash and then invest, be all invested or not invested strategy. A lot of people do that, and they certainly can do it better than I can. But to me, it's always striking a balance between offense and defense and being as tactical as possible, not being afraid to say either this isn't working or this did work, but I don't think it's going to continue to work. Because the markets of today, because of all the new players in it and so many other reasons, the markets of today reward folks who invest tactically. And what I mean is weeks and months, as opposed to investing buy and hold for years. So I think if you combine the offense defense with the tactical nature, that to me is a replacement for what bonds used to do. Do you get the cash flow income? No, you're not going to get 6% cash flow, but you can pursue a mid to high single digit return. And like I said, sometimes you can surprise yourself, okay, or you surprise the people that you're investing for, and you put out some, pretty eye-popping numbers. Or in a year like this one, where it started so poorly, we can make money. And it's not about earning the cash flow, because rates are so low across the globe that if you reach for cash flow, if you reach even for dividend income too much, you might make a 5-6% yield and then lose 5 times that in principal. So that doesn't make any sense either. So, I've created not a bond substitute using bonds. I have created through Sun Garden Core portfolio a replacement for the role that bonds used to play for investors in their portfolio. And frankly, I think it'll be a decade or more before we ever go back to doing it the other way. And I'll be the first one on board when the conditions are right, but we're so far from that, that I don't count on it anytime soon. And that's why we do what we do the way we do it.
So much money has gone into cryptocurrencies. As a person who's a technical trader, is this a good move by people, sheer speculation, or is this another South Seas adventure from the 1720s, or as I like to say, tulips from the 1600s?
Well, I will refer everybody to what I've written it's funny, Jim. I thought that I was going to get away with not having to address crypto on this call. I was wrong. No, I mean, look, to me, a chart is a chart is a chart as long as you have some semblance of understanding of what's going on around it. You know, we screen down to 300 ETFs. That's our universe. And that does include several in the crypto space, whether it's directly through the ETF to try to track the coins, or through blockchain as a mechanism. I'm a much bigger believer in the future of blockchain than I am in the coins being anything other than a speculative vehicle. But you know what? At the end of the day, it's about making money and about not losing big. And if crypto is one asset that allows us to do it through some of those ETFs, I'm as game as anybody else. I will say this: when it comes to the longer term view on crypto, I am the one, and look this up. But I wrote an article not too long ago for Forbes.com. I have a column with Forbes, and I write a regular column on investment strategy for financial advisors at U.S. News and World Report. So at Forbes, I recently put one out, and it basically said, here's how Bitcoin could go to 10,000 instead of 100,000. Now, I don't know where it's going to go. I'm just saying that when I look at the charts, I see the possibility of a crypto crash though. But it's going to take a while because there's so much resistance to it. So in the meantime, we might as well enjoy the ride. And frankly, I look at, there's always a little spot in our portfolio, even though it's a bond substitute or a bond replacement portfolio. There's always a little spot that we call kind of the volatility section. And in that section, we might buy actual volatility ETFs, which are very volatile themselves, whether it's long volatility or short volatility. You can do it both ways. But that's also typically where we put our crypto position. So maybe it's going to be a 2-3% position, whereas normally we would have 5 or more likely 10% in a single ETF, if not more.
We'll have more with Rob Isbitts right after this.
Did you miss the huge gains in growth and momentum stocks with your trading? Do you want to own the hottest stocks and sectors during the next stock market rally? The BAN, Best Asset Now Trading Alert newsletter will let you know which stocks to own, including entry, targets, and protective stop prices. Visit www.bantrader.com to learn more.
Welcome back. We're speaking with Rob Isbitts. How does rampant inflation affect technical trading?
So that brings me back to I would say probably the most important thing that I can say to anybody that is, whether you're a new investor or an experienced investor who is trying to make sense of these markets. So I am firmly of the belief that the following statement is true. In fact, when I give PowerPoint presentations, we have this quote up there, and it says, who's the quote from? Rob Isbitts, me. The markets tell us a continuous story. We just have to listen. To me, that summarizes charting and the advantages of charting in a nutshell. So reverting that back to inflation. So, how can you see that there's inflation pressure building up before it's actually building up? Just look at the charts. And don't just look at one chart. Don't just look at the S&P 500. Don't just look at gold. Look at 15 or 18 commodities. Look at, like I said, 300 ETFs we track, but they represent, I believe it's about 160 market segments. So you get to see everything now through the more mature world of ETFs, and you get to see it play out intraday every day. So how do you see inflation and how do you take advantage of it? Well, first, you get a consensus by looking at enough charts, whether it's day charting or night charting, going back to what we were talking about a few minutes ago. But you will start to get a consensus. You'll start to see the same thing. And so in today's world, you might see, okay, commodities on an intermediate term basis are a little bit pooped out, but long-term basis, there could be tremendous potential going forward. And so you have to manage that to your time frame. The other thing that we see is interest rates. And particularly when I look at U.S. interest rates, one of the ways that we have taken advantage of rising inflation, is to buy, ETFs unlevered, because I don't like leverage. But we buy ETFs that are, that profit from rising rates. So basically you're shorting bonds, but you're doing it through a long position in an ETF. And I think there's a lot of that type of stuff out there. I think the bottom line question, I get this all the time. Well, when the market's going down, what do? You just got to go to cash, right? Well, no. If the market's going down, if the market's going up, and I mean any market, not just the main averages. Well, if you have access to investment, okay, ETFs in our case, that are specifically designed to go the opposite of what a certain index is doing, then that's your answer. So you don't have to sit on the sidelines forever. Cash buildup doesn't hurt if the market picture is opaque. But I firmly believe that investors need to understand that there are a lot of ways that they can profit from a price of something going down, and more those types of things are coming out.
Rob, if you had just one piece of advice for people who are looking to get into investments or want to protect their investments, what would it be?
Avoid the scammers and the folks that look like it's too good to be true. Investing has become a rat nest. As I heard somebody say the other day, I think I was watching one of those CNBC American Greed shows. So many of which take place in my home state of Florida, by the way. For some reason, anytime you have money involved, and a lot of money involved, the ne'er-do-wells are going to come in because they see an opportunity to exploit. I see so much of that out there on a daily basis, and sometimes it's intentional. There's people really trying to just take your money without offering much in return. And I kind of take that personally, given, the 110,000 some odd hours I put into doing this, the right way. But the other type are the type that don't know what they don't know. And those would be the folks that are on some of the, let's say, more progressive social media channels, the newer ones, the TikTok, Instagram, as opposed to the LinkedIn types or the Twitter types even. People have to be very careful. As soon as something seems like it's too good to be true or too easy, you have to have a critical mind and you have to second guess before you move forward. And frankly, that's part of charting too, but I think it's also part of life, especially in the age of social media.
How important is it for investors to inform themselves about how things work so that they understand what's going on when they talk to their investment counselor?
Oh, I am a huge believer. The very first newsletter that I wrote directly to clients, it was called The Educator. And I have believed for a couple of decades now that people should want to be educated about this. The problem is, when you have a 13, 14-year period in which nothing goes wrong, and when it does, it's only for a blip, then it's easier for people to either get overconfident, indifferent, apathetic, or all the above. And the problem with that is that you're not prepared for what will happen. Look, I have seen enough in my years of being a professional investor and from my days of being an advisor to individual clients, and managing mutual funds. So I think that people should if they're going to put that much of their money into it, they should do it with intent. They shouldn't just leave it to somebody without understanding. That doesn't mean you have to understand it so well you could do their job, because that's a long way. I mean, a lot of people will be like, hey, can you teach me, what you know? Well, we got 110,000 hours to catch up. I'm not sure how quickly we can do that, even in the internet age. So I think people should get educated. And really, frankly, I think a lot of that falls on the advisors. I praise where necessary and where appropriate in my industry. I'm also very, very critical of my industry. And I feel like a lot of financial advisors today are kind of punting on the investment management process. They're outsourcing to third parties that are really built for scale and efficiency on their end. And that doesn't do anything for the advisor's client ultimately, and the advisor needs to understand the difference. Frankly, that's why we built the, as we're calling it now, the robot. We'll see what we end up calling it, but because we wanted to put a framework into any financial advisor's hand so that they can make their own rules with a little bit of coaching from us, and then deliver something to their clients that makes asset management an actual asset to their practice.
Rob, thank you so much for chatting with us.
Well, thank you, Jim. This was a pleasure, and thank you very much for the questions.
My guest has been Rob Isbitts, co-founder and chief investment strategist for SunGardenInvestment.com. I'm Jim Goddard.
Thanks for joining us this week on the Technical Traders Podcast. If you found value in our show, subscribe and give us a rating or share it with a friend. That would be greatly appreciated as well. TheTechnicalTraders.com, your source for technically proven strategies to make more money with less risk so you can take your trading to the next level. Comments made on the Technical Traders Podcast are an expression of opinion only and should not be construed as investment advice or recommendations to buy or sell any financial instrument. This information is for general information and educational purposes only. Guests on the show are not compensated for their participation. To view our full disclaimer, please visit our website at www.thetechnicaltraders.com.